So we stopped here actually last time in your ANSOF model. It gave us these growth strategies. We said that we have market penetration. So market penetration was old product and old market. Market development was new, old product and new market. Product development is, so this is your old product. I call it product and I call it market. So old product and old market. And market development is again old product, but new market. Product development is your new product, but market is old. And here I gave you example of your Apple Watch. So market was old, but product was new. And diversification, where you are going for the new product and probably new market as well. And like I said, that new market does not necessarily mean the geographical area. It is your target audience. It could be in the same geographical, in your same country, same region. It could be in a different country, different region, but you are actually trying to address the needs of a different group of people than what you were already doing. And today we are going to discuss our focus. Our topic for today is diversification. Okay, we call it diversify, to diversify, and then overall situation is called diversity. And diversification, it is a process in which you either you are going and tapping the new, you have how to say, into new areas. And we call it two types of diversification: related diversification and unrelated diversification. So diversity of products and market. In the past, it was not uncommon, which means that it was quite common. They should have written in the past, it was common for organizations to produce and sell one type of product to customers operating in the organization's home market. So one type of product, and they continue to supply the same thing. You are making cheese and you are doing cheese for probably 40 years. So one product you were doing and you continue with that. In recent decades, it has become increasingly common for larger organizations to modify the types of products they sell and the markets in which they operate. This is known as diversification. So you are changing or increasing your product range and you are adding your markets more and more. Now, what we are going to learn here, the need for diversification, the types of advantages and disadvantages of the different types of diversifications, and their advantages and disadvantages. Like, why do we do diversification? The first question is that why do we do diversification? Advantages are economies of scope. By the way, like I said, that there are two types of diversification in general terms, if I say. One, I call it like related, and the other one I call as unrelated. So your idea for diversification, for related diversification, is that if you remember your value chain, you want to get benefit of your value chain. So you have some already obtained, some capacities and capabilities, and you know that using the same capabilities and capacities, even if you enter into a new market, you would get benefit. One example of related diversification is that you have a restaurant, okay, and then this is an established restaurant. It's a good brand. You have developed your brand and your reputation, and then from the restaurant business, you say, I'm going to join, or I'm going to start the catering. So food catering service, okay, catering for probably some events, maybe catering for offices, or any type of catering. So from restaurant, you do catering. And in catering, what you need to have a kitchen, which you already have. You need to have some, people and processes in place to make food, which you already have. The only thing you need now is probably the distribution of that. And it is also possible that you might have distribution to some extent also. So you want to get benefit of your strengths, which you already have obtained. And based on that, you do diversification. So this is an example of related diversification. So when you go for diversification, one advantage is that you have, economies of scope. I didn't say economies of scale. Economies of scale means that when you produce more of something, that is called economies of scale, which is called large scale manufacturing. So you are doing at mass level, economies of scale. Now, this is economies of scope. So you are increasing the scope. It is opposite to the economies of scale. They may result from greater use of underutilized resources. Okay. You might have some underutilized resources, and by using diversification, you might be getting, how to say, you know um, getting benefit of your resources. I give an example. You are a construction company, okay, and you do large projects, you take up large projects, and then for large projects you definitely need to buy a lot of construction equipment. In probably cranes you are doing, electric generators you are buying, forklifters are there, excavators are there. So whatever type of construction equipment, you need to have it for your own business needs. But then you also know that at some periods of the time, during the year, you might have some lesser projects, and your equipment probably is not fully utilized. So what you do, that apart from your construction business, you set up a new company, which is like, rental of equipment business. You start renting out the equipment. So what you're trying to do, you are already into that business. You already have got the assets, you already have got the resources, and you have the team for maintaining those assets, because these assets need maintenance. You already have that maintenance capability as well. So you go into another business, which is rental of that construction equipment, and this will actually create you synergies, and this will also help you to fully utilize your resources. Then you have corporate management skills, may be extendable across a range of unrelated business. Like Richard Branson's Virgin Group is a good example. So they do many, many, many different things. So if you have, so these are the advantages, because you have got the skill. Like we said that I've been focusing throughout that people are very important in the business, and especially your managers who are capable, competent entrepreneurs. And by the way, not only entrepreneur, even if your employees and your staff should also have that entrepreneurial skills. So you've got a good team of managers, and with this good team, whichever business you will enter, there is a big possibility that you will be succeed. Diversification can increase market power via cross subsidization. A high margin business unit can subsidize low margin one, enabling it to create a price advantage over its rivals and build market share. Um, Here you can imagine, and if you remember, I was giving you one example of my company that was not part of of our lecture, but I just gave a separate example that we were doing some transportation. We had some vehicles, and we were providing service to the top tier like oil companies, BP, Shell, Total. And then we set up a smaller company for local customers, grade 2 or tier 2 customers, we call them. And it gave us a lot of advantage, and we increased our market power. So we were in the upper domain, we were in the lower market as well, and we already had the assets, so we didn't need to buy new one a lot. And we just transferred the assets from one entity to another one, and at a very low cost, we were able to do it. Diversification in some cases allows organizations to exploit existing superior internal processes to seize opportunities to establish new businesses. This exactly will be, it will help you. I mean, my previous example, which I gave you, that this trucking business or transportation business opening up a new company, again, this point will fit in there because we had got those systems and processes in place. We knew the business, we had security, we had safety procedures were there, our experienced staff was there. So even when we enter into the local market for smaller clients, we went into very confidently that these are our internal processes towards safety. This is our HSE policies. This is how do we do the work. This is how do we do, our processes. And it helped us. It just differentiated us from other local suppliers who never were taking care of those issues. So yeah, like it you can enter into the market with a stronger position. And this is what happened with us when we entered into the local market with a lower price, with all our abilities and capabilities, our managerial skills. We just tapped the market throughout. Okay, you asked the difference between economies of scale and economies of scope. Economy of scale mean that you are doing the same thing at a larger level. For example, I am making sports shoes, and before I was producing 1,000 pairs per week. Now I'm doing 2,000 pairs per week. I purchase more machinery, I expanded, and now I'm doing 5,000 pairs per week. This is called economies of scale. Okay, economies of scale. So this is, okay, when I'm expanding from 1,000 to 5,000, this is my scale. I'm increasing my scale. And because of increasing that scale, I will get some economy. Economy means that I will get some financial benefits. Economies of scale, the word economies of scale means that when you are increasing or expanding your production, you are increasing your scale, your volume, and as a result you make some economy, you do some economies, which means that you do some savings, which means that you reduce your costs. So reduction of cost as a result of increasing production is called economies of scale. Am I clear on that? So the financial saving, the savings which you make, the reduction in cost which you do as a result of the size of the business, as a result of increased production of something, that is called economies of scale. Am I clear on this economies of scale?
Yes, sir.
Okay, now
ये तो मैं कर रहा था, ये लोग पार कर रहे भाई, तो नहीं।
now economies of scope on the other hand means that again you are getting some benefit, again you are doing some economy and you are making some savings in cost, cost, etc., but not as a result of doing more, but as a result of doing different things. I gave you an example, like I have a restaurant business, and I start the catering thing. So if you are only doing
माइक खोल लो।
catering, if you are only doing, so if you are a catering business, you are only doing catering thing. So you set up a company only for doing catering. You have to hire the chef. You have to hire, the, how to say, you have to set up a kitchen. You have to set up some other facility for making the food. But I am already in the restaurant business. I don't need to probably hire more. Maybe I need to hire some additional staff, but I still can use many of my existing resources. I can use my kitchen, which was probably before underutilized. So when you do so, which means that I am getting some benefit by changing the nature of my business, by adding more products or by adding more business into it. So economies of scope means that you are getting some economic benefit by, not by increasing the volume of existing thing, but by adding some new thing. Like I gave you a perfect example, restaurant and catering. If I make a restaurant bigger, probably I'm going for economies of scale. But if I say restaurant and plus catering, so I'm getting some financial benefit as a result of opening a catering business, which is an example of diversification and which gives me an advantage of using my underutilized kitchen. Underutilized my cooking facility or whatever. So that is economies of scope. In any case, economy means the financial benefit. So either you get financial benefit by increasing the size of the existing business, or you can get financial benefit by, uh, you know, adding into another business line. Many times we have now, as we move forward, and I will explain you forward integration, vertical integration. I will show you that how you can utilize more of your existing resources in a better way. So this topic has just started. We will continue and we will learn many more things. So questionable reasons for diversification. Why do we do diversification? To respond to environmental change. One reason for diversification is environmental change. And environmental change does not mean some ecological environment. I mean, your business environment, market, there are some changes in market, probably trends, probably customer behavior. So you go for diversification as well. I give you again, I'll keep the same example of restaurant and catering. So, I mean, people used to come to my restaurant a lot, let's suppose. Now I see that because of, some more traffic issues, work lives, work routines, traffic jams. People don't come out in the lunch break. They prefer to stay in. So I say, no problem. I will deliver the food there. I create a catering company which is delivering the food. That's a response. That's my response to the change in the market. So environmental change in order to protect shareholder value by, for example, responding to the emergence of new and threatening technology development. It is possible that because of technological development, you do that. This can, however, be used as a cover to protect the interest of top management. Typically, this will lead to ill-considered acquisitions that destroy value. Okay, now that's a small line, but it has a very long story to speak. Before I go back to start speaking on academic and following the slides, let me tell you that what happens in diversification. Generally, we do diversification for several different reasons. Now I'm doing a general discussion, which will be very helpful for you to understand the overall topic. Systematically, we will do it later, step by step. I'll give you overall picture. We do diversification. One reason was that we say that we have some underutilized resources. My construction equipment is lying idle. Let's start some rental company, a diversification. My kitchen is underutilized. In restaurant, only these much of people can come in who are in the local vicinity. And I know that I have a bigger kitchen. I will never have my hall fill in. Let's do some catering thing. So this is one reason, using underutilized resources. And of course, increasing the value, increasing the shareholder value by maximizing the profits. One reason is that changes in the environment, that I am forced to do that. The environment is changing in such a way that I need to respond. And in order to respond, I diversify. Another reason is to against risk management. That is for the risk management. Sometimes you diversify, like you say that not all the eggs in one basket. So, I mean, some restaurants businesses have suffered a lot due to this COVID, but those who had delivery setups, they are still surviving because people are not dining in or not sitting in, so they can deliver. So in any case, many businesses, they got hit in different type of situations. So sometimes you do diversification for as a risk measurement, as a risk management thing. You try to manage your risk through diversification. Sometimes you do diversification for growth or exploring the new areas. So that's a good thing actually. But the negative side of that is that many times when you are doing diversification, uh, shareholder value may go down, because diversification means that either you are going to a new market or you are going for a new product. And going for a new product and new market definitely has a higher level of risk than your existing product and existing market. So one thing is for sure, that diversification means more risk. This is number one. And sometimes managers, they take some ventures, like different managers have different risk appetite. Shareholders want to take more risk or less risk. Managers, they have their own perception of the market. They have their own risk appetite. Risk appetite means that for me, uh, you know driving until 100 is safe. If I'm driving at more than 100, more than 90, it is unsafe. I think it is risky. For you, driving until 120 is safe. Above 120 is risky. So you and I, we have different risk appetite. We have a different understanding and perception of risk. So the same happens in business. Me as a shareholder, I prefer probably think this as risky, and you think that it is not risky. So sometimes managers they take such decisions that they enter into risky projects, and which ultimately probably could hit the business in the long run. This is one drawback of diversification. Second, actually, first one was that you are entering into new products and new markets. As a result, you are getting the risk thing. One more thing is that many times the new businesses which you enter, they are giving lower returns as compared to your existing ones. I gave you an example last time that we were doing that transportation business for the best market we already had picked up for, BP. We were doing it very good, making a lot of money. Then we diversified into the local market, and we were selling it almost at the half of the price, and we were making less profits. So for us, the reason was different. We didn't have financial reason, but if you see that move from financial perspective, our return on investment had gone down. So it is possible that in my restaurant business, I am making, let's suppose, 30% return on investment. And when I go to catering, probably I'm doing only 22% or 20%. So my overall return on investment may go down. This is one more reason. Now, just one word to attach here. Diversification is done in businesses. Diversification, the word is also used a lot of time in the stock market. When you purchase shares of one company and then another company and then another company, so we say diversified portfolio. So investors in the market, they do not buy shares. So if you've got $100,000, you wouldn't buy shares of $100,000 in one company. You actually would like to diversify. uh, Probably you will buy invest money in 10 or 20 or 30 different types of companies, so that if it one goes down, the other goes up. So if you lose money in one place, you gain money in another place. That is also called diversification. This is stock market diversification is not my topic, but there is one sentence which I just want to speak. For that purpose, I brought up this issue of stock market diversification. We know that one of the most successful stock market investor is Warren Buffett. And Warren Buffett is the person who had made his all his worth out of the stock market. I mean, at one point in time, he was the second richest person in the world. Now IT companies have taken the lead, so Amazon and this other things have come up. But at one point in time, the richest person, the richest man was Bill Gates, and the second richest was Warren Buffett. And their wealth was, for a very long period of time, like 5, 6, 7 years, they remained one and first and second position. Now, these people are not in third or fourth position because other companies have taken over. Anyways, Warren Buffett is the biggest stock market investor. Uh, just for your information, like few months ago, he purchased shares in Apple for approximately $24 billion. I'm saying $24 billion investment he made in Apple. So, what he says about diversification, he doesn't do diversification. Now, that's very interesting. He is the biggest investor who does not invest 100,000 or 500,000 or $1 million. He is investing in billions of dollars. And he says that diversification is an approach, or uh, it is it is an approach taken by the ignorant. He says that diversification is an approach taken by the ignorant, that those people who invest in stock market and they are buying shares in one company and they are not really very much sure what will happen to it, and in order to avoid their risk, they invest in another company because they didn't know about this and also they don't know about that, so they diversify. But if you are very much sure about the business where you are investing, you don't need to diversify because you are sure that it is going to go up. So anyways, This was his approach to stock investing in stock market. No diversification. We'll come back to the topic. So anyways, we say questions for diversification, questionable reasons for diversification, environmental change. I got disconnected. Give me a minute, I'll check my connection, please. Okay, can you see the slides now?